There have been a lot of news headlines lately about the topic of a market crash, especially during COVID. But today, we're going to take a bit of a different angle. I'm Adam with the Walker team of Intero Real Estate. Don't forget to subscribe for weekly updates and market insights. Let's start by going back to the beginning of the modern day housing boom, which began after World War II. Think of all the GIs coming back from the war and the GI Bill that let them go out and buy homes. The American dream was born. And today, 2 out of 3 people own their own home. This was the catalyst for the housing boom. When you look back, you can only see one real area where homes lost significant value, during 06 to 08. Remember, that was caused for 2 reasons. 1, loose lending standards, and 2, homeowners use the equity in their homes like ATM machines. When they owned more on the homes than what they were worth, people were underwater, had to walk away from their homes. During that time, over 9 million homes went into some type of distressed sale. So, will homes lose value this year? The short answer is no. At least, that's what the experts are saying. The average of these market expert predictions is about 9% forecasted appreciation this year. The interesting thing is that here in our area, we have already appreciated more than 9% year over year. But what about those affected by COVID? What about foreclosures? The number of forbearances continues to edge downward. We're just under 700,000 mortgages in forbearance right now compared to 4.6 million in May of 2020. Here, we can see the story of the loans exiting forbearance programs. As of March 31st, 37% were paid in full, almost 45% were on repayment plans, and under 19% are still in trouble. If these folks are in a challenging situation where they need to sell, chances are they have equity in their homes and can sell and not foreclose. Like we said before, lending standards are nothing like they were in the early 2000s. This graphic shows product risk has been virtually eliminated and borrower risk is significantly curtailed. As a result, foreclosure activity is at an all-time low because it's harder to qualify for a home loan. We can see here, lending standards are tighter now, where it's much harder to qualify for a loan with a lower credit score. Another factor is percentage of ARMs, or adjustable rate mortgages. They are at an all-time low. Remember, back in the housing crisis where there were a lot of adjustable rate mortgages. Today, we're only seeing about 1.7% of loans with this plan. Now, more adjustable rate mortgages will come into play as we see interest rates continue to rise, but that's not a bad thing. There aren't really any bad financial products, just misused financial products. The next question that arises is that as inflation rises, people aren't going to be able to afford their homes. Here's a study from the Fed that looks at the household mortgage debt ratio for mortgages as a percentage of disposable personal income. Today, we sit at 3.8%. In 2007, that was 7.2%. The percent of debt as compared to personal income is lower than it's been since the 80s. What about cash out refinances? As we remember from 2008, people borrowed money on their homes, and when housing prices fell, they walked, ultimately causing the infamous housing crisis. This is a look at the difference in annual mortgage payments for cash out refinances. That's the original payment minus the new payment. For the last couple of years, the difference in payment is marginal. This report from Freddie Mac shows that 1, people aren't using their homes like ATM machines like they used to, and 2, equity harvesting, which is repositioning their home equity into another market like stocks or something else, and is far less common. Lastly, let's consider one more important thing in our local market, and that is false appreciation. When we start to see price reductions, we need to remember that we're just coming out of a market with a mass amount of overbidding. Homes sold for crazy prices, and now those neighbors are hoping to get those same prices when they decide to sell. They incorrectly price their homes at that same high price, and when it doesn't sell, we see significant price reductions. This is often mistaken for the market crashing, when in actuality, it means that homes are selling closer to their true values again. See my false appreciation video for a full explanation on this topic. So, to conclude, the facts do not support a housing crash coming. A recession? Possibly. But we know it happened in 3 of the last 5 recessions, right? Home prices actually increased. It is still a phenomenal time to become a homeowner. Again, I'm Adam with the Walker team of Intero. Thank you, friends. Stay tuned.